Coming to markets now. The Fed announced inflation slightly higher, GDP a lot lower. They still maintain their provision for 2 rate cuts in 2025 and 2 in 2026. And then, very interestingly, they made an announcement on quantitative tightening. What are your thoughts? First of all, let's take inflation and GDP first. What are your thoughts on those, and especially the big downgrade in GDP?
At the end of the day, what the Fed is trailing through the new forecast that they make, the new dot, is that they see that the risk is a big S. It's the big stagflation risk. That's what they are telling you. They are telling you that the tariff story is bringing them to believe that they need to consider the risk of a kind of stagflation, even if it's not the kind of 1970 stagflation, but nevertheless is the risk of a kind of stagflationist development in the US economy. I think that also you need to take into account the fact that they revised upward the unemployment rate by the end of the year. So they are, in a way, uncomfortable about the fact that at the end of the day, they are taking notice of the fact that there is slowing down in economy in the US in terms of growth, and that there is more of an inflation risk in the US economy in the short term. What is interesting, and I'm not sure that it was quite wise, is that the Fed discussed again the issue that this inflation threat is transitory. And we all know that in 2020, it was not the best guess they made about the future development of inflation. I don't know why they went for such a word. Maybe it's because they want to reassure the market and to keep a kind of interest rates expectation and inflation expectation anchored. But nevertheless, it is something that we need to have in mind. When it comes to the decision in terms of monetary policy, they didn't act. But what is also interesting is in the dots, you can see if you make the difference between the median and the average interest rates forecast cut that they have, there is a difference. If you look at one, you see 2 rate cuts. If you look at the other, you can see that at the end of the day, they have pushed upward their target for interest rates in 2025, meaning that there could be only 1 rate cut. I still defend that there will be 2 rate cuts because there is a slowing down in the US economy. And that's something that we need to keep in mind. When it comes to the quantitative tightening, it was a decision that is connected that they don't want to have some instability in short-term interest rates because there was a kind, they decide to reduce the amount of quantitative tightening. It's not completely over, but they don't want to create instability on short-term rates because there could be some lack of liquidity at one point. So it's a management of this liquidity issue that induced them to promote such a development. It was announced before that they would reconsider quantitative tightening. There was not full agreement on that measure, but most of the voting members decided that it was the right step forward.
Yes. They've announced that they're reducing quantitative tightening from 25 billion being released into the markets to 5 billion. That's a huge change. Along with, so inflation's slightly higher, but big downgrade in GDP, rates still on their way down. Didn't you expect more of a reaction in the bond market than that?
The bond market has reacted quite strongly in terms of development in the course of the last 6 to 8 weeks. Don't forget that in January we're close to 4.8% on the 10-year bond, and now we are at 4.28 this morning. And we were close to 4.20 in the course of the last 10 days. So it means that the bond market has reacted quite strongly in terms of development. Why? Because remember that at one point there were many people thinking that there would be no rate cut in the US, and I'm speaking about a month and a half ago. And suddenly people have reintroduced expectation of 2 to 3 rate cuts in their assessment for the monetary policy. So the bond market has anticipated such development, and that's the reason why you had such a fall in bond yield in the course of the last 6 weeks. So no, I think that the market has reacted quite normally when it comes to the modification of expectation concerning the monetary policy. Take note also that there is a development that is impacting bond yield lately. I mean, by that, over the last 4 days, is now some rumors that Mr. Trump could go on April the 2nd for more moderate tariff introduction And this is also one of the factors that is supporting this morning the future on the equity market in the US and in Europe. It's because it seems that there is some move backward from the US and not being too aggressive on tariffs.
In terms of our bond portfolios, which part of the yield curve for US bonds do you favour?
I still believe that the short to medium term is the most interesting one. But when it comes to a bond strategy, what we need to have in mind and what is very important, and it's something that has emerged as a key issue in the course of the last few weeks. First, you need to remember that a lot of people, in terms of bond strategy, have decided to go a lot of full speed credit. And it was full credit in the portfolio, high yield investment grade. So, a company that was the major basis of a bond portfolio in the course of the last 2 to 3 years. I think that lately you had some sign that you need to be more careful. So more than the position that you have on the curve, you should consider, do you want to, first of all, stick with a strategy that keeps a lot of credits in your bond strategy? That's the first question. And the second one is considering that you have some deteriorating economic condition in the US, is do you want to be full speed in high yield? And that's something that many major banks have come out with research on. You need to be more careful on that. So I think that when it comes to where we are on the bond market, with the assessment of the Fed of last week, what you need is to stick with quality. Don't run after bad debt anymore. Don't try to be smarter by taking too much risk on your bond portfolio. Because at the end of the day, you are facing condition where we all know that volatility is back on the equity market. You want to develop a bond strategy that is really going to decorrelate you from the risk of the equity exposure that you have in your portfolio. You don't want to add risk through the bond strategy to your equity risk. I think this is the main decision that you need to make in the course with regard to the recent bond development, to my point of view.
At the beginning of the year, your target range for 10-year bonds was 4 to 4.7, I think. Have you finessed that since?
To tell you the truth, I was wrong in January because when the bond market, the 10-year get to 480, I did not jump into it. And it was a mistake because at the end of the day, there was a very good rally on the 10-year bond in the US. No, I have not changed because I think that you still have a lot of uncertainty. I still reckon that the risk of recession maybe has increased a little bit. It doesn't mean that this should be a central scenario. I still believe that there is a slowdown in economic activity in the US, but there is maybe a risk of recession. Don't forget that we still have some important measures that the Trump administration can come with, which, by the way, could be very supportive for the economic activity, which is the tax cut and the deregulation. So, to my point of view, we still have a lack of visibility on that front. We don't know if they are going to proceed quickly or not. And second, you still have this issue of inflation because the tariff will produce some inflation, to my point of view. I don't know if it's going to be transitory. And so, as long as I don't have more visibility on both growth and inflation, I stick with my view. And I still believe that we could finish the year on the 10-year bond at 4.7, 4.8%.
Coming to the week ahead now, what are your thoughts on the leading indicators being announced this week?
Very important because it will tell us that we already had this morning Japan. Japan was lower than expected. What is very important is what is happening in Europe. We want to see if there is really some kind of turnaround that is looming in Europe. Is it confirmed by the numbers that we will get? I think that in the US, again, people are going to be they are going to watch that very carefully to see if there is a stabilization of the recent downward trend on this indicator. And don't forget that by the end of the week, we will have the PCE, the Price Consumer Expenditure Index, which is very important because it's the key measure of inflation for the US.
That's expected at up 0.3 from the previous month, which is the same as the number from the previous month compared to January. That makes nearly 4% on an annualized basis. That's much higher than the 2.7% that the Fed is expecting. If that goes higher, how do you think the Fed are going to react?
I think that they are going to keep, their option open, and they still remain with the view that they are data dependent. At the end of the day, what they told us last week was, we are data dependent. We are going to act on the monetary policy on the basis of data. If they see that inflation is going up, it will reduce their ability to really lower interest rate very quickly. By the way, I'm not expecting rate cut before June of this year. I think that for me, until June, the Fed is going to be stand still and keep pat on the monetary policy. And I think that if they have such a number, it's going to convince them that they need to not act on interest rates in the short term.
Thank you very much, Francois. Speak to you next Monday.
Bye bye. Have a good week.
Bye bye.